Hello everyone, we're here on our webinar. It's Webinar Wednesday. So we're here talking about financing. It's such a crucial part of what you have to do as real estate investors. So most of the people that are joining us today are real estate investors or want to learn how to do real estate investing. And the big key component of it is having a lender work with you that understands all the variety of different needs that you have. So you can work with different banks, you can also work with brokers, and there's a difference between them. So bankers can only sell the products that that bank offers. Brokers are allowed to shop the different loans to different vendors and different organizations. So their job is to place your loan with the best lender that they can. So in the past, bankers sometimes have better rates, but less likely to close on them, and you have to have what they call A paper. So there's a lot more stringencies, and it takes a long time to get an answer back from the bank whether or not you've been approved or not. So for the most part, mortgage bankers have a specific niche, but for investors, I find that we tend to do not the same transaction each time. It's not like we're buying the same type of property, so you want a lender that works with you that understands different varieties of financing at different stages. For instance, if you buy a single-family house with the intent to renovate it and then to resell it, you need to make sure that you have a lender that you're working with that understands that you have to have rehab loans, so you're not going to go conventional right off the bat. Then they have to understand if it's a primary home that there is a loan that's available for you for that. So that's why Everyday Capital was created, Everyday Funding was created, was to help in the funding for originally the members of Long Island REIA, but now we've extended it to pretty much everybody. So today's topic happens to be one of my favorites. This is truly how you get wealthy in real estate in a short period of time. And it's cyclical. So in other words, we're in the top of the market again, where funding is becoming much more available, where it wasn't just 3 or 4 years ago. These loans did not even exist. So make sure you take advantage of what's being offered here. So we're going to talk about refinancing, the 5 steps of refinancing that you need to complete for your BRRRR strategy. So when we talk about BRRRR, what we're actually talking about is this acronym, meaning buy, rehab, rent, refinance, and repeat. So the third R in the BRRRR strategy stands for refinance, and that's where a lot of people get hung up. And that's also where a lot of people, if you mess that stage up, does not allow you to do the 4th step, which is repeating the process. So we have to look at making sure you buy the property right, which is a discussion we've had in the past on our other webinars, and you're free to look those up. Also, then the renovation costs, making sure that you don't over-renovate or under-renovate. Either one will have a devastating effect to getting a good long-term rental in there. Because the real asset to your property is not the property itself, is actually the quality and the strength of your tenant, their ability to repay you for your debt and give you a profit, okay? And so the refinance, it's never about what you pay, it's also about how you refinance. I once grossly overpaid for a property due to whatever errors happened at the time, whatever happened, and was able to refinance it and restructure the debt better than I had on the onset going in. And actually that's going to be one of our biggest performing properties. So it's really important that you understand how the refinance works, because it could make a bad situation better for you, okay? So that's why I want to focus on this refinance today. So there are 5 steps. So 1, you want to find a lender you could work with. Obviously, we'd love you to work with us, but it's more important that you find the one that you can work with the best, that understands the variety of types of lending. Right now in the market, if you're going to do the BRRRR, you're going to need to do what's called a double close. It does have additional closing costs, but it does have additional benefits to it. So you're going to need on the outset a hard money lender that can quickly close. And a lot of people get hung up on the rates of hard money. hard money is very competitive, very lucrative, but they all fall in the same ranges. Hard money typically is anywhere from 2 to 4 points on the inset, and anywhere from the lowest I've seen is 9 on institutional hard money to about 13 or 14%, okay? If you think that's a lot, if you're only holding the property 90 to 100 days, 120 days, that is such a small minutia of the cost of getting into it. I would rather you guys continuously buy properties than be hung up on saving $2,000, $3,000 on interest and points. That's just silly. You're tripping over dollars and missing out on the long-term wealth you could be getting. All right, you should be doing as many BRRRRs as you can at this time of the cycle, because the funding will dry up and you will not be able to get these loans for a while. So we wanted you to maximize your benefit for this, because this will definitely help you ride the wave of the correction in the market. So having a lender that understands your strategies and understanding the market and understanding what investors need is really important. Referrals are the best way to find them. So we recently had Think Realty at our meeting last night, Long Island RIA, and they're a great networking association as well. They're a magazine, they're a community of an online community. They're great. Bigger Pockets, always love them. Your local RIA, you definitely want to meet with them. But more importantly, what you want to find out when you're talking to the lender is the guidelines before you apply. Okay, you want to know, is this loan going to report to my credit personally or not? That to me is a big, big game player, because I could have 80 mortgages, which I do, and none of them appear on my credit report, and that's crucial. The second is, do they go off of stated income, or are they using my personal income off my W-2s and my tax returns? Again, there's many lenders now that don't require any tax returns. That's huge. You need that. So make sure that you have the answer to that. If you're working a 9-to-5 job and proving your income is not a problem, this may not bother you. So, but for somebody who has multiple businesses, it's always encompassing trying to get all those paperwork together. And then also, when they analyze it, the underwriter initially comes back with a lot of explanations, because we have large deposits for different transactions, because we're real estate investors. The other thing, and this is a big key, you need to know when you refinance, what's the maximum you can refinance out, and is it off the appraised value, or is it off the loan to cost value? What's the difference, right? So the appraised value is what the property would appraise for in today's fair market, okay? So once you've renovated it, it's the ARV number that they're going to work off of. Or is it off the purchase price and the amount of rehab you did? All right, the whole goal here is to pull cash out. So your goal is to maximize by creating as much equity as you can, so that you can tap into that equity, pull it out, so that you can go and repeat this process again. All right, so that's really important. The other thing you want to find out is their seasoning requirements. How long do you have to own the property before you can start your refinance? Some have, 1 year, 6 months, 3 months, 3 months, 90 days. Some have 1 day, but you can't actually close till the 90th day, which means you can start your application beforehand and then just close on the 91st day. So that's really important. Ideally, you want the ones that close 90 days on seasoning with the appraised value, okay? Because it's realistic to think that you can do a renovation. It usually takes about 6 to 8 weeks, and then get a renter in there. The other thing is making sure you have all your documents, knowing what's going to be required. Our tax return is going to be required, our lease is going to be required, our down payment checks or 2 months rental checks, is insurance prepaid for a year required. Find out those things beforehand, so it's a much smoother process for you, and you know what you're getting into. Second step is you want to make sure your financials are in order. You want to know if they require tax returns, that they're completed and filed in the proper year. I can't tell you how many people have submitted in applications and their taxes haven't been filed the last 3 or 4 years. There's a form called a 4506T. That means if they ask you to sign it, they're asking to verify that you filed taxes. Not that the loan is based off your taxes. They just want to know that you're actually filing it. And you may ask, why does that matter if they're not going to take the income off of it? What they want to know is that you're not going to have a potential judgment against you or your corporation, so that there could be a tax judgment which supersedes a mortgage. Okay, so that's why they ask for that. You need to know your correct payoffs. Another issue that comes up quite a bit when people are filling out the application, they took out a loan for $100,000 with a hard money lender, and let's say your hard money lender was nice enough to build in the interest and the points on the back end of the deal. There's some private lenders that do that. So, excuse me, in that case, what's going to happen is you want to make sure that you have the correct payoff. It's $100,000 plus maybe 3 points, so now it's $103, and then say you have $7,000 in interest. Well, your payoff is no longer just going to be $100,000. It's going to be $110,000. And when you're refinancing, that extra $10,000 has to be paid. So you want to make sure that you're accurate, as close to accurate on your payoffs that you submit. Another thing that happens a lot of times too is your outstanding taxes or tax liens. I know as myself as a flipper, I don't typically pay the taxes during the time that I hold the property if I'm flipping it. I'll just pay it on the resale when I'm going out of the transaction. So if a tax is due during that time period, I'm usually holding it maybe 2 or 3 months, if that, and there's no real tax consequence other than paying a little bit of interest on it. However, if you wait a year and then you go to refinance, you'll have a year of arrears taxes that you'll have to calculate in your payoff. So that's really important. The other thing is you want to make sure that there's no other additional liens put on the property. So if you took a private lender and that private lender put a second lien on it during the process, you need to make sure that that lien is going to be satisfied as well at the closing. The loan will be rejected if you just don't let them know that you're going to bring the money to the table to pay off and satisfy that second lien, okay? If it's recorded, you can't show it recorded and then suddenly unrecorded without a payoff, okay? So those are important things to note. Leases. Some lenders require completed leases to submit in for your application. And not only that, but they'll require the first month's security deposit and first month's rent as proof that you really have a tenant in there, that you just didn't make up a lease. Show a photograph of the, driver's license, and they want to see actually 2 canceled checks. All right. So a lot of times a lender will require that. If you know that ahead of time, make sure you correctly do it. Some people do a month-to-month lease. That's not going to be acceptable. It must be at least 1 year. Okay. So that's really important. The other thing is the income from the property. You need to make sure that it's not paid in cash, all right? It actually has to be canceled checks or put into the bank account. Ideally, checks are the best, or money orders. Either one are acceptable. So if you, from your tenants, only accept certified funds, being money orders or certified checks, that's acceptable. Or some people are now processing it through like a PayPal service, and that can go into your account. But you need to be able to show that through your bank account. The other thing is accurately knowing what your credit score is. This, I can't tell you how important this is. You've got to protect your credit above all else, okay? So the credit score, if you tell us that it's going to be a credit score of somewhere around 680, and we underwrite the loan for 680, and then it actually comes back that your score is somewhere around 656, well, you could be denied for the loan. And I would hate for you to go through all this process. So the goal is to hit the 720 as high as you can, as a consistently or higher. That means protecting against unnecessary inquiries. Okay, so those come up quite a bit. Making sure your bank statements show proper reserves. So what is reserves? Inevitably, in any type of refinance, the bank wants to see that you have reserves so that if you run into a pinch or your tenant leaves, that you have so many months in reserves. Now, the bank will dictate what that will be. It'll be anywhere from 2 months to 6 months. On a Fannie Freddie product, they will require 6 months on every property you own, investment or whatever. So that becomes very cumbersome. So you'd have to have and it has to be a liquid account. It can't be an IRA for FHA. So in other words, it would have to be stocks, funds, mutual funds, something like that that could be liquidated quickly, meaning less than a week, so that they could pay for those reserves. So if it's 3 months reserves and your monthly payment with taxes and insurance would be $1,500, you'd need to have $4,500 in the bank. That's for the 3 months reserves. So make sure you have that. Now, some lenders have come up with the neat strategy of actually allowing reserves being your IRA account, which is crazy, but that's what they're doing. So this might help you guys out. I use my IRA for these particular lenders to show the 2 months or 3 months reserves that I have. So it's money I don't really touch. It's sitting there, and it's easy to show. All right, so make sure you do that. And I can't state this enough. Don't be applying for new credit and application while you're going for a mortgage. We just had an incident with somebody who recently, we already had approved for the loan, and right before the closing, they will pull your credit one more time, usually the week right before your closing. And in this case, they did pull the credit 3 days before the closing date, and she went out and applied for a lease on a car. And it was a $600 a month payment, and it threw her debt-to-income ratios off completely, and she was denied the loan, and we could not close on it. And the sad part is she had hard money on it, and she wound up going into default. So these are really important things. That just wait till you're done, finished, and the refinance is complete before you go applying for new credit. Okay, so that's getting your credit in order. The third step is making sure you submit your application in correctly and then with timely responses to additional documents that are needed. So, your application. A lot of people get intimidated by a form that's called a 1003. They may not know how to fill it out because it's the first time they're doing it, or they don't do it that frequently. So feel free to ask our staff. Patricia is our loan officer here. She is phenomenal at it. A lot of it we can help you fill out, but don't skip things. Don't miss your primary address, your Social Security, your employment history, your monthly income. Don't miss any of those things because it'll just delay the process. When you have to send in your documents, Patricia usually sends you a list of the documents that are required. The first email seems very cumbersome, but if you send in all the documents and we submit them all right away, the turnaround time is much faster, and there's less documents to come back with on conditions, and you can get approval much faster. All right, so it's really important you do that. So when you submit your documents, you must submit in with all the pages. The typical one we see is bank statements. If you have a bank statement and it has 6 pages and the last one is blank, you'll usually see those words, this page is left intentionally blank in the middle of the page. They do that so that they know that all 6 pages of the bank statement are there and there's nothing else in the bank statement, okay? So that's important to note. Send in all of them. And I know in technology age it was just so much easier to just snap a picture and send it. That's not going to be acceptable for the underwriters to use. It has to be in a PDF format. So just scan it in and send it in, that'll help expedite the process as well. Remember to be efficient and mindful of the lender's knowledge and time. Why? Because they're advocating for you to get this loan. Trying to buck the system and say, well, why do I need that? That doesn't make any sense. If it's a genuine question, yeah, but if some people are doing it in an argumentative way, but disagreeing about a document that's needed, even if it's such a simple one, could just lend to more delays and ultimately a denial of your loan. Or it means you're hiding something. So I'll give you an example. We do investment properties. It's financed for investment properties, commercial only. You cannot live in those properties. So some people will try to do it so that they can live in the properties. They will ask for the tenants to supply, you know, on your primary home, you'll be asked to supply your own utilities in your name. If you can't produce that, or it says the address of the house that you're refinancing and claiming to be an investment property, that will be a denial. So when we ask for a document saying we need your personal utility bills, sometimes people argue with us, oh, well, you don't need that, blah, 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 blah. And then at the end, all it does is delay it, and ultimately, in this case, the loan was denied because by the time she finally got it to us, it looked suspicious. Even though that was the truth, it was suspicious, and the loan was denied. So timely manner of when you return the documents once they're requested is key for your success of a refinance. I can't stress that one enough. So make sure within 24 hours you have all your documents back. And expect additional document requests. So here's how the process works. The application is submitted in with all the initial documents. It's reviewed, and then you get what's called an approval of denial right there. You'll get an approval with conditions, so then you'll have to meet all those conditions, and then it has to go back into underwriting, and that usually takes anywhere from 3 to 5 to 7 days, and they're reviewing title and everything else at that time. And then it comes back, and it may require additional conditions if you didn't satisfy all of them on the first one, okay? So they may need more letters of explanation. They may say, oh, you have a lot of inquiries recently. Why is that? So you'll just have to write statements to that effect if there's a large deposit. These are typical things that the underwriter will catch and need explanation for, okay? And then just remember, you're asking these people for hundreds of thousands of dollars. So be responsive, be cooperative, and work with the people. Don't take it on an adversarial way, you know, I can do better here, or something like that. That's only going to frustrate yourself and everybody else in the process, okay? Our goal as a team is to close you on time, okay? So we all have to work together. So just as important as making sure your paperwork is all looking good, you have to make sure your property looks good, especially when they do the inspection through the appraisal. So you have to make sure that whatever you submit, you're showing yourself that you're organized and professional and that you know what you're doing, that this is your business. Remember, you're going for commercial business loans, all right? So act like a business. You don't want to be looking, you know, I have somebody who's, you know, fumbling through paperwork. Oh, my dog ate this. Literally, she said that. My dog ate my paperwork. I'm like, we're not in high school anymore. So you have to make sure that you're professional and your property looks good. When they go to determine your value of the property, if you have a tenant who hasn't cut the grass, who has destroyed the house, it's, you know, there's clothes everywhere, it's just a mess, it's going to impact the value of your property. And your goal is to get it to the max value you can get so that you can pull out the most amount of cash you can. So just make sure that your property is in the best condition it has. Make sure somebody's meeting the appraiser when they go, such as yourself. If you can't be there, a representative like a realtor or your property manager. I usually have my property manager go. It's less threatening, and they usually supply comps as far as the rentals which helps the appraiser out. And it also what properties have sold for, because they're always a licensed broker as well. And you have to be careful not to over rehab your properties. I kind of said that in the beginning, and also under rehab your properties. You have to do it for the market that it's suited for. For instance, we had TJ Bencho from last night, and he was talking about in the Pittsburgh market, it's acceptable to do Formica cabinets. You restore the cabinets that are there. Well, if you tried to do that in a house on Long Island, that would not go over so well. It would not get the values up. And the other thing is that you have to make sure that you're going to get your return on investment. One instance we had was a master bath. Yes, it could be enhanced better. We could put a nice tub in there, and that master bath could have looked nicer. But at the end of the day, it's still a master bedroom with a master bath, full bath. That's not going to adjust the appraisal number either way, just because it has more features in that bath. But if you had a brand new roof on there and a new windows, that would increase the value of the house. So you have to look at something that's going to give you what cost is going to come out to what cost is going to come back to you. All right, so make sure you know that. And if it costs you $10,000 to do a roof and it's only going to improve the value by $10,000, I wouldn't do it. But that's typically not the case. We just did an inspection in Connecticut where we had it where the house, if it had a finished basement, would increase it $15,000, and all it needed was about $7,000 worth of work. That's a worthwhile improvement, okay? Because you're going to get the value out to cash out. So it's really important you understand the process, pretty much what I told you. Once you submit the applications in, you'll get a response. You need to clear up those responses, send it in, and typically there's one more round of satisfying those issues, and then it goes to clear to close, and then all the parties have to work together. That typically takes on a buy and hold anywhere from 30 to 45 days. That's reasonable. If it's a fix and flip, we can usually get those done in 2 to 3 weeks. Basically, all you do is submit your application in. They do an appraisal. There's no going back and forth. Approval is given within 24 hours. The longest part is coordinating for the appraiser and the closing itself. So that's why it takes so long. Also, understand what type of loan you're applying for. Don't do hard money on a buy and hold. That's just silliness. Unless you have a strategic plan for it, but just know it. And vice versa. Don't plan to go into a loan thinking you're going to get long-term financing on a property that needs rehab, because that may not happen. The other thing is, don't lie on your application. If it's an investment house, let it be an investment house. You don't pay these points. You don't pay these interests. Your tenant does. It's a cost of doing business. So don't lie about it. It'll get yourself into some serious trouble. Because if you're trying to say you're a primary homeowner and you go through a primary Fannie Freddie loan, which is government-backed, and they find out that you used it for investment purposes just to get the lower interest rate, you have opened up yourself to a Pandora's box of issues and some legal defense, okay? So don't do it. It's not worth it. Just remember that loans with rehab must be disclosed at the time you're doing the application so that we know. We don't want to do the appraisal and find out, oh, it needs, you know, the plumbing's not hooked up or the electric's not working. Those will not be funded with conventional purpose loans. So make sure we know that ahead of time. Also, know your comps. Don't just rely on yourself, especially if you're new. Talk to 3 or 4 different people. If you're part of a RIA, ask a friend. Say, hey, would you mind helping me comp this out? I'm getting XYZ amount of value. Sometimes people are off by $30,000, $40,000, and that is huge because that's money you would not be able to pull out, or money when you refinance you have to come up with at the table. So make sure you're as accurate as you can be about your comps, all right? Now, that being said, we have no control of the appraiser. So if the appraiser comes back with their own, you know, their godlike opinion, there's no way you're going to change that. Sometimes it's worth changing the loan to a different lender if it comes out too low. Other things, it's careful, again, not to over-rehab or under-rehab, okay? So we have the understanding the process. Sorry, I don't know why my computer's making so many noises. And then just remember, your lending officer is your friend. They're your advocate. They're not your adversary. Help them to help you, okay? So why use everyday funding? We're investors ourselves. My name is Melissa Jeanette Shea. I have over 80 mortgages. I didn't have to use any tax returns for any of them. I continue to buy on a monthly basis, so I really understand the niche of financing. This was created out of a need for the members, and so it's just kind of snowballed. So we're here to help you, and we understand what your needs are. We stay on the cutting edge and the marketing trends of what's going on with financing. That's why I'm telling you, get as many loans as you can right now, because it will dry up literally overnight. We give free education like this webinar because we want more people to be more knowledgeable. A more knowledgeable borrower will make the process a lot easier for us as well. And we're just not order takers, we're advisors. We want to help you create a business, not just a one-time transaction. We're licensed in over 20 states for residential loans, and it's all the main important ones, so hopefully that helps. And we can help you pre-qualify before you submit offers. So I hope today's, if you have any questions, you can talk to Patricia. She's out today. She had a family emergency. So if you know her personally, just reach out to her and just send her warm wishes. But she's our loan officer here. If you have any questions, feel free to call our office. Our number is 631-343-8700, extension 501. Or you can email her at patricia@everydayfundingservices.com. Or you can go to our website, which is everydayfundingservices.com. I'm going to open it up to any questions if anybody has any. I wanted to be mindful of the time. But if you have any questions or emails, you can chat me or you could email it. All right? So thank you for joining us on our webinar Wednesdays. We'll see you in 2 weeks for another webinar Wednesday.